The Australian dollar is firm because traders are repricing the Reserve Bank of Australia as a rate hike risk. Australian dollar trades frames the pressure because the move stands out because several major central banks are leaning easier, while the RBA still sounds restrictive. The supplied setup includes a 40% chance of a November hike, inflation at 3.8%, unemployment at 4%, and AUD USD above 0.67. The useful part is the test in front of the story, not a broad market slogan. The quarterly inflation report is the first major confirmation point. That gives the opening a measurable checkpoint and keeps the story tied to named levels, named participants, named rules, or named product steps. The baseline comes from domestic data. Sticky inflation and a tight labor market give the RBA less room to pivot toward easing. Commodity stability and China stimulus add support, while technical momentum points toward the 0.68 area if the move holds. This baseline matters because it gives viewers the part that can be checked before any larger conclusion is drawn. It also limits the story to the facts already visible. The currency strength is supported, but it remains data-dependent. The viewer can separate the setup from speculation. One side is the factual baseline, and the other is the result that still needs confirmation. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. The mechanism is interest rate divergence between Australia and other developed markets. In plain English, when one central bank may keep policy tighter, its currency can attract yield-seeking capital. For Australian dollar trades, that mechanism matters because the Australian dollar benefits only as long as the RBA stays more hawkish than peers. The stress point is specific, whether inflation confirms the need for another hike or undercuts the current pricing. This is the part that makes the headline useful, because it explains why one level, deadline, filing, reserve figure, integration, or data point can change behavior. The direct impact lands on forex traders, Australian exporters, importers, and consumers. A stronger currency can help lower import costs, but can also reduce the value of foreign earnings for exporters. Tourism can also feel pressure if Australia becomes more expensive for visitors. The practical consequence is currency strength creates winners and losers across the real economy. That is the viewer value here, understanding who faces the change and why the change is not the same for every participant. The effect is not evenly distributed, so the segment focuses on the group with the clearest supported exposure. The unresolved part is whether the RBA actually follows the market into tighter policy. Rate hike pricing does not guarantee a hike or a lasting rally. That gap matters because the central bank can stay data-dependent and change tone if inflation cools. The cleaner proof would be firm quarterly inflation and hawkish language from the RBA. Until that appears, the story should be read as a defined setup with a real open question. That does not make the story smaller. It makes it cleaner because the unresolved detail is exactly where risk can be misread. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. The concrete signal to follow is RBA guidance, quarterly inflation, and China-linked risk appetite. Those inputs decide whether the rate differential remains supportive. Australian dollar trades becomes easier to read if inflation stays sticky and the RBA keeps a tightening bias. It weakens if the RBA turns dovish or China data weakens the commodity-linked bid. The final readout is simple. The currency is trading on policy divergence first. A strong next signal should be observable, not emotional. A filing, close, data release, official term, usage number, or liquidity change.